What are these weird things called T accounts? I mean, who makes this stuff up? Well, I'm going to break it all down for you in this video, and then I'm going to give you another resource that will not only help you understand T accounts better, but help you get an A on your accounting homework. Stay tuned. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence the T Account Rex. So let's dig right in. First of all, what is a T account? Well, a T account is a simplified version of an account record. So think about it in these terms. Think about your checkbook register, and then think about scribbling down some numbers on a napkin. Well, a T account is a simplified version of your checkbook register where we're going to scribble things down on a napkin. So it's just a simplified version to help us kind of track some things. And the reason we call it a T account is because it's shaped like a T, and accountants are really creative like that. So how does a T account work? What we're doing is we're taking accounts from our chart of accounts, and of course the link to that video will be in the description. So we're taking those accounts from our chart of accounts, things like cash, accounts receivable, supplies expense, and we're just going to use this simplified version to kind of map out what's going on with transactions that impact those accounts. So every account in your chart of accounts would have a corresponding T account. And here's what that looks like. We're simply going to have the account name on the top line, and then the divider between the two is the debit credit line, okay? It's to keep your debits and your credits from fighting with each other. So we want to make sure that we have your debits on the left, your credits on the right. So what we're going to use T accounts for is to track transactions, just like we would in a journal entry or in a spreadsheet. We're just doing it in this weird thing called a T account. Now, before you can understand how T accounts work, you've got to understand normal balances of accounts and debit and credit rules. Okay? Obviously, there'll be a video for that, so you can check that out. But let me just give you the brief rundown. So different account types have different rules for increasing and decreasing those accounts. These are normal balances for those particular accounts. So assets, expenses, and owner's withdrawals or dividends have a normal debit balance. So if an account has a normal debit balance, we increase that account by debiting it, and we decrease it by crediting it. So assets, expenses, dividends, owner's withdrawals have a normal debit balance. And then liabilities, revenue, and equity or capital accounts have a normal credit balance. So if it has a normal credit balance, we increase it by crediting it, and we decrease it by debiting it. So my way of remembering those accounts is to say, after eating dinner, let's read ebooks. AED, assets, expenses, debits, after eating dinner. Let's read ebooks, liabilities, revenue, equity or capital. The normal balance is a credit. So every time we're increasing or decreasing an account, because there's been a transaction, we're going to increase or decrease those accounts based on those normal balances. So let's look at some quick examples. So example number 1, we have an expense of $10. And as far as we're concerned, it doesn't really matter what the expense is called. It could be anything. It could be office supplies expense. It could be salaries expense. For the purposes of understanding T accounts, we're just going to call it expense. Keep it simple. So we have an expense of some kind of $10, and we're going to pay cash for this. We're not going to do accounts payable where we're going to pay it later. We're going to straight up pay cash. So what are the accounts being impacted? We know cash is being impacted, and this expense account is being impacted. So let's talk about those two accounts. We have an asset and we have an expense. Those have normal debit balances. So they increase on the debit side, decrease on the credit side. So let's talk about our expense. Our expense is increasing. We have incurred an expense, so our expenses have gone up. An expense has a normal balance that is a debit, and we want to increase it, so we're going to debit this expense account by $10. Debits go on the left, credits go on the right. Debit and credit means simply left and right for the purposes of accounting. So we're going to increase our expenses by $10 in our T account. And what's happening with our cash? Our cash is decreasing, right? So it has a normal debit balance. We increase it on the debit side, we decrease it on the credit side. So we're going to decrease our cash by crediting it $10 in our T account. Transaction number 2, we have $20 in revenue. We have sold something to our customers for $20. And let's assume our customer is going to pay us cash. It's not accounts receivable where we're going to get paid later. We're getting cash. 2 accounts being impacted. A revenue account, and again, it doesn't matter what you call your revenue account. For the purposes of this exercise, revenue is revenue is revenue. So we said that revenue has a normal credit balance. And what's happening with our revenue? Is it increasing or decreasing? Well, it's increasing. So as a normal credit balance, we're going to increase it by crediting it for $20. What else is happening? We said we're getting paid in cash. So what's happening with cash? Cash is increasing. So if we have a normal debit balance for an account, we're going to increase it by debiting it, left-hand side of the account. So we're going to increase our cash by $20 by debiting it in our T account. Transaction number 3. Let's say our owner makes an investment in the business. That investment is going to be $5. So what are we getting in the business? We are getting $5 in cash, right? The owner is putting money into the business. So we're going to want to increase our cash account. And how do we increase an asset? We increase it by debiting it. So we're going to put that $5 into our cash account. Now, every time you're dealing with debits and credits, there's got to be at least one of each. There can be many more than that, but there's got to be at least one of each. So what is the other side of this transaction going to be? Well, the owner is making an investment. So the owner now has equity in the business. So we're looking for an equity account of some kind. And again, for the purposes of this exercise, we want to keep it very simple. We're just going to call it equity. We would normally call it something like Joe Smith equity or Joe Smith capital. But in this case, we're just going to call it equity to keep it simple. So what's happening with our equity account? The business now owes him that money, so he has created value for himself in the company. So capital equity accounts have normal credit balances, so we want to increase it by crediting it. We're increasing his equity in the business. So we're going to credit our equity account by $5. Now let's say the owner decides that he wants to take some money out of the business. So he's going to take $2 back out of the business. So what's happening with our cash account? Our cash account is decreasing, right? Has a normal debit balance, so we're going to decrease it by crediting it $2. Now let's talk about his equity. He's reducing his equity in the business. He put in $5, now he's taking $2 back out. So we could use his equity account and debit it to decrease it. But we want to keep track of how much he's put in and how much he's taken out separately. So we set up this other account called dividends or owner's draw or owner's withdrawals to track what the business owner has taken out of the business. Or if it's a business that sells stock, then we want to keep track of the dividends that we have paid out to the stockholders. So we keep that in a separate account. So we said that dividends has a normal debit balance. So we're going to increase the amount of dividends or owner's draw by debiting it $2. So we've debited our dividend account and we've credited our cash account. So those are like some of the simple basic accounts that we would be looking at. When we start adding on complexity, like adding a bunch of different expenses or some different asset accounts, like accounts receivable, or some additional things like liabilities, like accounts payable, we just multiply the number of T accounts that we have. But those basic transactions are always going to work the same. You're debiting and crediting the same things, but it may be to a more specific account name like supplies expense. So once we've done all of our transactions in our T accounts, the next step is to get a balance for those accounts. Now, when you're doing balances on your T accounts, you would expect to see that balance end up where a normal balance should be for that account. So if it's a cash account, for example, cash is an asset. Assets have normal debit balances. You would expect to see the balance of that account be a debit balance. So when you're totaling up your accounts, you're adding up your debits, you're adding up your credits, and you're finding the difference between the two. So if your debits are greater than your credits, it's going to go on the debit side. If your credits are greater than your debits, it's going to go on the credit side. You don't want to have balances on both of those columns. You want the difference between the two, and it needs to go either on the debit side or the credit side, depending on the account. Once we have those totals, then we take them and we put them into what's called a trial balance. And the purpose of a trial balance is to make sure that you have debited and credited equally. We said every debit has to have a credit. At least two accounts are going to be impacted in every transaction because of the accounting equation. So we want to make sure that our debits equal our credits. That's the only job of the trial balance. Do your debits equal your credits? If they don't, it means that something has been misposted, and you go back and go through each transaction to figure out which one you messed up on. I like to keep it real. There are things that we teach in accounting class that we would never do when we're actually doing accounting. Now, is T accounts one of those things? We actually use T accounts in real life. If I have a transaction and I'm trying to figure out like what happened with this, what went up, what went down, I will absolutely grab that napkin and sketch out some T accounts so that I can sort through all of the accounts that are impacted. And of course, when you've been doing accounting for a while, it's not going to be like a day-to-day transaction that you need to do that for. It's going to be something that's more complicated. But I absolutely, after 35 years in accounting, will still grab a piece of paper and draw some T accounts for those complicated transactions. Now, your next steps would be to go more in depth on how to analyze transactions using T accounts. Go to the Analyzing Transactions T Accounts video in the description, and you'll be able to get into the more specific transactions that you typically see in accounting class and on your accounting homework. So you'll be able to work through all of those typical transactions. So when it comes time to do your homework and your test, you are going to be a T Account Rockstar, okay? So until next time, stay balanced, my friends.